Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. Welcome you to another video. Today's video, I'm going to talk about a subject that I'm asked about often. And to some people, it'll just seem maybe even like a silly subject, but I'm often asked, how does the stock market work? How do you use the stock market to make money? Well, how does it function as an entity? And what can I expect if I decide to invest in the stock market? So let's go ahead and go into the FastGraphs Fundamental Analyzer software tool, and let's discuss how the stock market works. Okay, what I've got on the screen here is a fast graph of the S&P 500 ETF Trust, and I'm going to talk about that in a moment. All right, but actually the stock market is probably best understood not as a casino or a game of chance, which a lot of people like to think of it as, but as a rational mechanism for allocating capital. In other words, it provides a platform where ownership in public businesses are bought and sold. At its core, the market is a real-time reflection of investors' collective judgment about value, opportunity, and risk. And you can see that looking at this Spire 500 ETF. Okay, when the market is euphoric about stocks, prices tend to rise, but they misappraise the intrinsic value of the company. When something scares the market prices tend to fall. But that daily volatility is just something that is really the nature of the beast, if you will. So how does the stock market really work? Well, let's demystify how it works. Think of it as a vibrant auction house where shares of public companies change hands based on simple yet profound principle of supply and demand. When there are more buyers, the price rises. When there are more sellers, the price tends to fall. All right, so when you buy a stock, it's also important to recognize that you're not just buying a ticker symbol. Like, for example, here's American Electric Power. All right, you're purchasing a piece of the real business. The black line in this graph represents the price of, in this case, American Electric Power. But if I take the price off, the fast graphs is showing you the actual business behind the price, how the company has performed as an operating business. Has its earnings grown? Has there been periods where their earnings have dropped? Also, if they pay a dividend, how consistently have they paid a dividend, which FastGraph depicts by this gold line, and then stacks all the profits below the gold line, which is what the company pays you as a shareholder. We stack that on top for purposes I'll talk about a little bit later. Okay, but you're actually purchasing a piece of this business, a piece of its assets, a piece of its earnings, and a piece of its cash flow. So public companies like American Electric Power and all of the ones listed on the exchanges, they issue shares in order to raise money, okay, to raise capital for growth, innovation, or even to return it to shareholders through things like dividends. All right, that's also part of the process. But once these shares are listed, investors can trade them on these stock exchanges with prices fluctuating on a minute-by-minute basis. That's why when you add weekly closing prices to this graph, you see all this volatility of the black line. Okay, investors are buying and selling almost second by second, minute by minute. And that causes all this price movement in the short run especially. And the price movements are actually the consequences of changing perceptions about the company's value, its future prospects, and economic growth. And outside forces like news publications or things that are happening in the world can affect whether the prices are rising or dropping over the short run. But in the long run, the growth of the business, in this case the orange line on the graph, is what ultimately drives stock prices. Okay, so it's important to point out that the stock market is not a random walk. Over time, prices gravitate towards the underlying value of the business. Now, with American Electric Power, as an example, you see it where the price gets below the orange line, which is the intrinsic value, it tends to move back into alignment. When it gets above intrinsic value, it tends to move back into alignment. So it's always constantly reverting to the mean. Stock prices gravitate towards the underlying value of a business. And this is what I call, this orange line, is what I call true worth or intrinsic value. Now, short-term volatility is inevitable. You're going to get these price rises and drops on almost any stock or any stock you've ever looked at. But in the long run, it's the operating results or the earnings of the company that's going to really drive the price towards an ultimate goal, if you will. Okay, but the market rewards patience, discipline, and a focus on earnings power and growth in the long run. And understanding the difference between price and value is what really matters most. Because remember, the market rewards patience, discipline, and a focus on earnings power and growth. So what are public companies? They're simply corporations like American Electric Power or any here that I could show you. These are utilities I'm looking at right now. These companies have issued shares to the public through an initial public offering. In many cases, years ago, this company's paid consecutive dividends for over 83 years, for example. And they invite anyone, whether you're an individual or an institutional investor, to become part owners of this business. And this becomes the responsibilities. Public companies must adhere to strict disclosure standards, making their financials open to scrutiny. This transparency is the backbone, if you will, of intelligent investing, which allows investors to assess management quality, profitability, and growth. Remember, when you buy a public company stock, you own a real piece of the business. You are what is called a shareholder. All right. Now, we can look at different types of companies. This is important because not all stocks are the same. You can look at fast-growing companies, like you can look at Nvidia, if you will, all right, which is a really hot stock right now in the artificial intelligence sector. And I'm going to shorten this so you can see it. Now, we see that the price in this case did follow the earnings growth, but it also followed it at a very high valuation. The fair value PE for this stock at this kind of growth rate uses Peter Lynch's P equals growth rate, and that's a 53 multiple. But look how closely the price has tracked that 53 multiple over time. All right, so the growth of the business is a big deterrent of how well you're going to do. You take another very strong growth company. You take a company like Fiserv, for example, which is in the transaction processing business. It has recently come into fair value, and you're going to see, once again, a stock, a company, a business who grows their business very consistently year after year after year. And then you're going to see the stock price reflecting that growth by tracking that growth. But it occasionally gets disconnected. Sometimes it gets well above the intrinsic value or the true worth of the business. And when it does, it ultimately corrects. But sometimes it takes a long time for it to correct. Okay? And the point I'm making at here, that when you're buying these stocks and when you're actually buying and selling shares, it's more than a piece of paper. It's a proportional ownership in the business. You are a partial owner of whatever business you own stock, whether you own 1 share, 1,000 shares, 1,000,000 shares, it really doesn't matter. Okay, but you're participating in the profits, growth, and risk. For example, when the stock price gets overly priced, that presents a period of high risk. But you participate in that risk also as an owner of the business. Okay, and you also have stocks. I'm going to use a different metric here. I'm going to use operating cash flow, and we're going to take a look at Amazon, which is another stock. So Fiserv has grown by about 15% a year as far as earnings go. If I look at Amazon and I look at it through the lens of operating cash flow, which I'm going to do here, you're going to see that Amazon has tracked its operating cash flow growth of about 28% a year. And by the way, that type of growth is going to give me rates of return that are commensurate with that growth. Here you see a 25% annualized rate of return from December of 2011 to October of 2005 that basically tracks the growth of the business. Okay, but not all companies grow that fast. Now, we take another good growth stock like Amerprise Financial, which is a asset management and custody bank, which grows about 12% a year, and you look at it from a standpoint of fair value. If you're looking at it trading at or near its orange line, you're going to get a rate of return that's commensurate with the growth of the business. We have about 12.6% growth, and we bought it at a discounted PE, so we get some PE ratio expansion, but we end up making a very high double-digit 15+% rate of return because the earnings have tracked the growth of the business over time. Now, not all companies grow fast like this. There are companies that grow much slower. Like, for example, let's look at a good utility stock. Let's look at New Jersey Resources here. It's about a 6% grower, And again, I want you to notice if I buy this stock at pretty close to fair value over this time frame, and sell or hold it to pretty close to fair value, I make a rate of return of about 6%. And again, that correlates very, very closely to the actual growth of the business. Now, my overall return is higher because I also get the consistent dividend income that this company has produced. Okay, so not all companies grow like Nvidia or Fiserv or Amazon or Amerprise. You also have these utility stocks that can actually be much slower growth stocks. Okay, here's Spire Inc., another utility, and you can always see where when the price gets out of line with the intrinsic value, it eventually reverts to the mean. That's also very important. But then you have very slow-growing stocks, and I've talked about this in the past videos that I've done. You get a company like Campbell's Soup that only grows at 2%, and you buy it at a reasonable value and hold it while it's at a reasonable value, and you end up making something pretty close to the 1 or 2% that the company generates. In spite of all this volatility, okay, the price is always reverting to the mean. And that's really how the stock market works. Remember, it's not just a piece of paper. Now, these stocks trade on various exchanges, whether it be the New York Exchange, the NASDAQ, the over-the-counter exchange, etc. So those things are important to know what they are. But the exchange is just a place where people can go and sell or buy the shares that they're looking at. Okay, so the market does have these exchanges, but they're just facilitators. They just are places where the individual stocks that I've been talking about here are listed and where they can be traded on it, meaning bought and sold on an exchange. So you can buy ownership or sell your ownership, depending on what the case may be. Now, despite the New York Stock Exchange, NASDAQ, over-the-counter markets, etc., you also have stocks that are sold as American depository receipts. So let's take a look at one of those. Now, what these are receipts that actually do not represent, well, they represent the home company, but they're not actually the company stock. They're actually a certificate or a receipt. It's called an ADR, American Depository Receipts. And what the ADR, and if we talk here, they usually represent sort of like a prototype of the stock. And here, it takes 3 ADRs of Honda Motor Company to equal 1 share in the actual business. And they're usually, what this does is it lets U.S. investors own foreign companies conveniently that trade on the American exchanges and denominated in dollars rather than their currencies. So they expand diversification opportunities, if you will. Then there's also instruments you can invest in called like derivatives, options, futures contracts. Their value depends on underlying assets. They can be used for hedges or speculation, but they're not the individual stocks themselves. They are more of a financial instrument. And then you have funds, okay? You have funds like ETFs and mutual funds, and you can buy those, and that's simply where you get a pooling of stocks. As I showed you the SPY, I can also show you the Russell here. And I want you to notice, if you remember seeing SPY S&P 500 a few moments ago, you look at the Russell. In this case, it's the Russell 3000 ETF. It's uncannily, instead of having 500 stocks, it has 300. But look how very similar this picture looks to the S&P 500. So, but it's clearly showing the overvaluation of the markets in general, if you will. Okay, so these ETFs, and we'll be soon having a full ETF package on FastGraph where you'll be able to look at all the major ETFs and be able to draw a fast graph of them. We're really excited about that. Then in addition to ETFs and funds and derivatives and some of the things I talked about, you also have real estate investment trusts, or what's known as REITs. The 800-pound gorilla there is Realty Income. Now, we normally evaluate or value these stocks based on something called adjusted funds from operations. That's a favored way, and that would be the gold line on the graph. But just like we see with regular public companies looking at earnings, when price gets disconnected from the orange line, it tends to revert to the mean. If it gets way below the orange line, it tends to revert to the mean. If it gets way above the orange line, it reverts to the mean. Below it, it reverts to the mean. Below it, it reverts to the mean. Below it, it reverts to the mean, and ultimately comes back. So focusing on the company's fundamentals, because fundamentals matter a lot, are really what you want to do as an investor. Now, you also have currencies or investment opportunities in things like commodities, like gold or oil or eggs, if you will. And a lot of times, a lot of investors like to use those to hedge against inflation or to diversify their portfolio. But I will point out those kind of investments don't pay a dividend. They don't split their shares into more shares like these other more traditional investments do. And there's a whole different game when you're dealing with those. So I think it's something you should be aware of. Now, I also want to talk about the difference between an investor and a trader. An investor is someone who seeks fair value, where the price is at or below the orange line, metaphorically on a fast graph, and owns the business and disregards the volatility, because what they're doing is they're trying to fully participate in the growth that the business offers plus the income that the business generates. Okay, and that's whether you're looking at something like we're looking at this REIT, or whether you're looking at a stock like Nvidia, which is a very fast growing company that we talked about, or I talked about earlier. You're participating in this growth. So these companies can generate significantly different types of returns depending on what they are. But that's, if you're acting as an investor, you tend to buy these things, you try to buy these businesses, become an owner of these businesses. And what you really want to do is think like an owner of the business and hold the business for the long run and let the daily gyrations of stock prices take care of themselves. Traders, on the other hand, are trying to guess when the price is at the bottom and then guess when the price is at the top and then buy and sell like that. In reality, though, it becomes very, very impossible, if you will, to do that successfully, because look how devious the prices can be. Sometimes fair value manifests itself very quickly, like we saw here. Other times, fair value takes a lot longer to manifest, like we saw here. And in some cases, we've got years and years. If you look at a stock like when I showed you Fiserv earlier, I showed you a business that was one that got significantly overvalued, and that lasted for many, many years until COVID came, and then it kind of hit a wall, and then it went sideways for about 3 years before it collapsed. But then once again, it rallied again and came back. And the problem is, as a trader, ever really know when those things are going to occur. I know they're going to occur. I know the market's going to revert to the mean, but traders are trying to exploit this volatility, and that can be fraught with danger and fraught with error. So I advocate thinking like a long-term business owner, invest in quality companies at reasonable valuations, and then hold them for the long run and let the power of compounding work in your behavior. The market is a voting machine in the short run, but a weighing machine in the long run. Patience and discipline end up being your greatest allies. Now, stockbrokers or brokers are really your gateway to the stock market. They execute the buy and sell orders, provide market data, and many even offer research tools. And for example, FastGraph is a research tool that can aid you in the decision making. They range from full-service firms offering personalized guidance to low-cost self-directed firms like Robinhood or even Schwab or some of the really discount brokerage firms, if you will. But the right broker depends on your needs and goals and objectives. But remember, a broker is nothing more than a facilitator, not a substitute for doing your own diligent research and rational decision making. And that's very, very important for everyone to understand. Now, you also have regulators. These companies that trade on these exchanges, they're subject to the rules and regulations of the agencies like the Securities and Exchange Commission, of course, banking regulators. The exchanges themselves face regulations. So even the market indexes serve as barometers tracking the performance of groups of stocks like the S&P 500 or the Russell 3000 I showed earlier. Okay, but they are just places where you can value these things and evaluate what they're looking at. Stocks trading far above their intrinsic value are vulnerable to correction, as you see here. And you got to remember that, while undervalued stocks offer opportunity. And useful tools like this FastGraph research tool that analyze earnings growth and valuation and then illustrate where the price sits in relation to that are very, very valuable. I can't imagine investing in stocks without FastGraph, because you got to remember that price is what you pay, but value is what you get. But why is all this important? Why is the stock market important? I think we'll have to understand that the stock market is the engine that powers economic growth. It channels capital to businesses, fuels innovation, and creates wealth for individuals and institutions. For investors, it offers a path to long-term prosperity if approached with knowledge, discipline, and in my world, a commitment to value. The market also reflects the health and optimism of the broader economy, influencing everything from retirement savings to job creations. So in conclusion, the stock market, how it works, is not a mystery reserved for experts. It's a rational system where patience is rewarded, intelligence is rewarded, and discipline is rewarded, and it's a place where value becomes extremely important. So what I always suggest is ignore the noise, ignore all the hype and hysteria, focus on the fundamentals, and I like to say, mind your own businesses. In other words, pay attention to the businesses that you own and don't worry about the overall market, because ultimately what you own is what's important, because it's a market of stocks, not a stock market. Hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to our YouTube channel for more videos like this, and also take a look at subscribing to Fastgraphs. If you own stocks, or ETFs for that matter, you need to invest in a subscription to Fastgraphs. It'll make you a great deal of money in the long run. It doesn't cost you anything if you approach it properly. It actually will save you money. Thanks for watching. We'll talk to you again real soon.